Morning everyone, morning. So I have decided I'm going to record this today. Obviously I'm trying to build the content library for the channel for the newer traders, but this particular video is going to be suitable for not just brand new traders, but anyone who is struggling to achieve consistency. And that's the goal. Even if you don't know it, that is really your goal. You want to be able to go, okay, I'm pretty confident that I'll, pretty much make the same amount of money this month than I did last month, Anyway, so I'm going to start off with the rule number 1 of technical trading. There are so many that are important, but if we're talking starting on technical trading, this is going to be rule number 1. So the first thing that I want to suggest, so these are all suggestions, everything I do is suggestions for you to try and then see how it works for you. But because I went through my learning curves, and I didn't just do it alone. I did it alongside other traders. So in other words, my awareness is, okay, well, I saw how it affected me positively and the people that were doing it as well. So that's where my awareness comes from. So the first thing is price action. So in other words, try for a while, maybe for a few days or for a day or maybe a week, try and look at a chart with nothing else except price action. A lot of people are intimidated by price action. They keep hearing, well, everything's about price action, and they have all these indicators on the chart. Bollinger Band is a classic one, and trend lines, all these. We've got so much stuff on the chart. But if we strip it away, it's quite funny because we're intimidated by the idea of learning price action. We think it's difficult, which it's not any more difficult than anything else. So we kind of avoid doing it by putting all these other things on top of price action. And we start looking at the MACD indicator and crossovers there instead of looking at price action. And we look at moving average crossovers instead of price action. And the funny thing is that if we just focused on price action straight away, we would learn it a lot faster, and it would be better for us anyway. So this is my suggestion, that you try looking at a chart with nothing except price action and getting used to that idea. So imagine it like this, as an analogy. Imagine that if you're trying to drive in your car, you're looking through the windscreen and you've got all this crap on your windscreen. You've got mud and bird poop and all this other kind of stuff. And instead of just cleaning your windscreen so you can see what's actually going on, you're just kind of putting more and more stuff on your windscreen. So you can't really see what's going on. You need to be able to see price action. It's not that hard. It is, so this is something we have to focus on. Okay, so price action is very important. What we also need to be able to do is, if we look, and again, the time frame doesn't matter. At this point, what matters is our ability to identify and read price action. So if I look at price action now, I can see that there are lower highs and lower lows. Okay, price is coming up very close to this recent high. If it breaks it, this downtrend is finished. Because every chart or it doesn't matter, any instrument on any time frame will go through phases of trending up, going sideways, trending down. And so this is currently in a downtrend. Okay, cool. It's also coming back into a key level. Now, if key levels don't stand out to you yet, don't stress, because they will over time. Again, your eye will start to pick up things over time. So don't stress about it. It will happen. It just does. It's a side effect. You can see it's coming back up into this level. So there is a potential level of support and resistance here at this point in time. Now, you could also see that it was a big drop and a big reaction up. So this is also collectively, this is a message. It's a very bullish rejection of the lows. And so there's quite a bit happening here. So because of so let me take you through what I see here. Because of the aggressive pushback here, which is in the collective shape here, if you combined all of this price action, you would get a bullish candlestick that looks, I'm trying to see if I can find a nice bullish candlestick. That price action collectively will look something like this candlestick here, or something like this. If you had to combine all of those 4 or 5 candlesticks into one, you'd have a very bullish reaction. So the message here collectively is that's quite strong. It does have a level of support that it may be resistance, but I'm thinking it's potentially likely to break past it. We'll see, and we'll see how that goes because of that. All right, so there's a story happening here, and that's all I really need to know at this point in time. Because of this key level where it might find resistance or it might break through, now's not a good time to trade it, because first of all, it's in a downtrend, but it's potentially on the verge of turning into an uptrend or breaking the downtrend, and it's coming close to a key level. So there's no reason to trade it right now, but it can go into a watch list, for next week potentially, or later in the week, depending on the time frame. But it also means I can still analyze it. So what I want you to take away from this is that we can analyze a chart to determine if there's some potential in it or not. Right. So that's really what I want you to do. But I'm focusing really on the last 10, 20, 30 candles. Basically what I'm doing is looking for about the last 3 or 4 swing lows and swing highs. That gives me a collective idea of what the market conditions are right now. So we could see that it was in a downtrend, producing lower highs, lower lows. Then it went into a shorter term uptrend, and then it went back into a downtrend, and that's where we are now. If we also look, we could see that there are potentially some key levels. So let's look at, so the next thing that's going to be important is that we have to be able to learn to identify kind of key levels. And so what I'm going to do here is I'm going to draw, I'm going to highlight the big turning points. So if we start up here, if this being the highest point that price had been, if that was the highest point the price had been since it's 2007, going all the way back to 1988. Then after that, the lowest point it went to would be kind of somewhere around here. Okay, so that would be the lowest point, from that high down to that low. Then I would say that this is a significant high, okay, because then it went up to a brand new high. And I would also comment that this is a significant low, this area here. So in other words, I'm looking at the extremes over long periods of time. Then of course you know that there's another extreme high up here, so that is all an extreme high. And we then hit a low where we are now. So that's those are worthwhile levels to take note of. Okay, so that's the first thing I want you to be aware of. Just casually note the big, extreme, wide moves that have happened. If you don't want to include these two, you just want to include extremes, then go for it. This one, in fact, isn't necessarily an extreme because price could carry on down. So, but this is where we are right now. And based on that rejection, I'm just going to include it currently. So the next thing that I'm going to do, these very faint lines that I have on in the background, I have only recently started employing that. Those are default. Most platforms, many platforms will allow you to add automatically horizontal lines. They shift, by the way. As soon as I zoom in and out, they will just adjust automatically. So they're there to give me a loose guide to, they're not framing around price. They're completely unaware of price. They're more about zooming in. If I zoom in and I change time frames, they'll move around. But they do help my eye observe kind of key levels. So this is what I'm going to do next. I'm going to start where price is now. So price is here. So I'm going to start and I'm going to work to find the most important 3 levels above and 3 levels below. That's what I want you to get into the habit of doing. Actually, 2 above and 2 below is probably fine, but 3 above and 3 below is fine as well. As it happens, I know that there is one close to where we are now. So a lot of times I get asked, okay, well, do I draw it through the wick? Or do I draw it through the body? Now, the truth is that they both matter. All right, what I'm really trying to do is to connect as many dots as possible. I want the level to connect as much as to slice through and connect as evenly as possible. The reason for this is that I'm looking clearly, if I can find the very central axis of that cuts through, that is being connected from both below, being tested from below and tested from above, I'm actually going to find the general price that the market considers significant. So I notice if I go back a bit, and this is not crucial, I want to weight my line, should be weighted more towards the front, pretty much. Although historical levels are always valuable, I want to weight it more towards the front. So if I find that this level doesn't touch these candlesticks over here, but it touches more of these, then I'm going to weight it towards these ones. I'm just noting that if I put it like this, it's very close to quite a few other levels. So I'm going to deposit that there and just leave that line there now. Okay, so that I think is a fairly significant one because you price key changes here. I'm going to count that as well. Okay, once in a while you'll get a small gap and you can ask yourself, is that level also significant? Now, if I see that there definitely is some kind of a reaction across the board, that's fine. Once in a blue moon, you can get 2 levels that are 10 or 20 points apart that are both quite significant. But that is not a common occurrence. So you have to, in those particular instances, make a decision. Go, okay, do I want to dismiss it in this case, or do I feel that this is valid? So sometimes I'm saying that you can get two levels. They won't be 5 pips apart. They'll be 10 or 20 points apart. And then you decide if you want to add those. So you remember that the person you're ultimately doing this for is yourself. Don't put levels in because you think that other traders need to see those levels. Put the levels in because it will help you identify those levels confidently as well next time. So again, I feel that we've got another level up here. I'm very interested in levels that have been tested from both above and below. I also like levels that are very crisp. So you can see there's a lot of touches over here, for example. So that's likely to be a key level on the daily or lower time frames, just lower time frames. Imagine this as a daily. It doesn't matter again. So I've put at least one above price action at the moment. I can see that there's potentially another level up here as well. So I'm going to go through and just consider that. There's also round number 8,000. So in this particular case, I may consider putting it closer to 8,000 as a guide. That will allow me, ladies and gentlemen, to be prepared. When I start approaching that level, I can then say, okay, well, that level, that area is potentially significant. All right, so those are key, because you can see if you look here historically, there's just a lot of reactions. So again, let's talk about these two highs over here. Okay, so these two highs here, I would say would qualify. If I really want to be pedantic, I would add that as one of those examples I was talking about where you could get two levels that were close to each other. So I would add that because in that particular case, there's enough evidence to support that there's clearly a significant, difference between the two. So I've done 3 above for now. And it's a monthly chart. It's going to take a long time to get up to that. I don't need to do any more, but if I am interested, I can see that there are levels here. This one's particularly good because it is touched from above and below. So that one is particularly significant in terms of that. Now what I'm going to do is focus on what lies beneath that. So if I look at this, I like that. So I'm going to deposit that there. Why? Well, because predominantly of this strong reaction against the chair, and there's a bit of a reaction here as well. Yes, there's potentially another level right there. If you look at it, there's potentially another level there. You can see that it's significant here, and that's probably on the lower time frames. So let's go down and add any others that I need to see. Now this is where it gets a bit messy. So I've got a level here according to this patch, and it lines up closely with these lows here. But there's not much before that. It's quite interesting. As you go further back in time, there's not a lot supporting that. There's a little bit here, just at that level, and those levels. And it's a round number. Look at that, 6,000. So I'm going to drop that in. Okay, so there's price. I've got 3 above, 2 below. Let's just see if I want to add any more. Yep, let's add in one more in here. Let's just have a look. Do I feel that that's a fair one? If I need more detail or more accuracy, there we go. So that's nice, because here I can see that there is a reaction from price here as well. So price actually came down, bounces off that, hits a ceiling there, breaks through, comes back, test that. So I'm somewhat happy with that. Okay, cool. So what I'm going to do now is then go down a little bit further. So imagine it doesn't, as I said, timeframes are kind of irrelevant, but I really don't want to overclutter my chart too much. I could even have 2 above and 2 below, but this is it. So the way that price operates, basically, forget about what you think is the case. Before the charts even existed, if you go back to the 1950s, 1940s, back to the 1910s, it was always about price, and therefore significant price levels. People didn't have charts per se, they didn't have computers. Even back in the 1990s, people were hand drawing a lot of their charts with moving averages. They had to hand draw the moving averages. They'd print them out and then hand calculate simple moving averages, which is part of the reason that simple moving averages are popular. So, and some of those traders, by the way, still operate today, and a lot of them are operating at the very top echelon. So if you're wondering why that's the case, because we often then find that those kinds of traders are operating at that, and therefore we can employ the older-fashioned way of doing stuff because they're still employing this. So this was that patch, that one little patch that I spoke about earlier that had kind of touches below on this level, and here we go, it's much more obvious here. And if I want to do that, I can. I think for me, the goal here is that I really don't want to overclutter my chart. So in this particular case, if I go and add this in, and I like the idea of color coding things as well. So I like that idea. So in other words, if it's more significant on a higher time frame, I would color code it, say green, like the 200 moving average. And then if I'm on so my lowest time frame would be the daily, I'd keep it blue. Then my medium might be the weekly, which I'd keep red, and then my monthly would be green. So I can determine as I'm approaching it if it's a very significant level, like a monthly level, daily or weekly. So in this particular case, I can just see there's a little bit of dipping below that. There's also a little bit of dipping above it. Okay, I don't want to obsess about this. in this case, I'm aware of it, so I'm not ignoring it. I'm just saying that it's noisy. And so in this particular case, I'm going to be a little bit more cautious on it, because you get this as well. And then you're going to start to suffer from analysis paralysis if that's the case. You could argue that there's a bit of a patch here as well. But again, I'm going to kind of take a bit of a breather on that. I'll be aware of it. I'll note it. If I want to, I could put a gentle sort of a note on that at some point, like a dotted line or something that highlights it. Because the goal here is to maintain my sanity. I want to identify things, but I also want to... You're going to get patches like this. So let's talk about this one in particular. So let's say I put that level in here. It's beautifully crisp here, but then it gets messy here. There's a little bit of a nice touch there, but it's generally messy here. So in that particular case, I would not mark it as a major level, because that wishy-washy behavior should not be the case if it was a major level. So what I may decide to do to help myself, not for the benefit of other people, but for myself, is make it like a dash line. So I can be aware it's there, but I don't want to clutter up my charts. So there we go. So the point now being is that if I start to add more, so this level I'm going to remove. Why am I going to do that? Because I'm trying to keep my chart at a minimum. If I go down to the daily, that's really where I'm going to kind of keep my key levels if there's anything else that I need to do. But I'm quite happy with most of these. So, and that's really it. So newer traders need to understand that what you're seeing right now is the most important information on your chart. You can, as you become more experienced as a trader, you will end up on a chart like this, because that's all you need. That's literally the basics. It's all you need. You don't need all the gadgets. But it's your confidence that really prevents you from doing it. And the irony is, because you don't work like this in the beginning, you don't actually develop the skills. But it's over time that you kind of almost, despite your own interruption or your own effort to not help yourself, you will still pick up the skills. And eventually you'll start stripping away and make it basically simpler. And so this gives me a general idea. Now, the way that price action behaves, so again, that tells you, looking at price action, nothing to be afraid of. Focus on the higher time frame to get a sense of the bigger picture, and then identify key levels, and don't clutter your charts. Okay, I've got above and below, but I've kept it pretty straightforward. Okay, so I can delete. I don't need that rectangle. So my chart is nice and clean. Yes, there are obviously some key levels here, but I know, because I've looked at the bigger picture, they're not as crucial. And so this is going to be ebb and flow between the big moves. And you can see now little patterns around those key levels, like breakout patterns there. That's very nice. It makes sense now, because these levels are significant. So the next thing that I want you to take away from this, so the first one was understanding price action. The next was going to the higher time frames and being aware of the impact of that. And the third part being that not cluttering my chart too much, obviously having a few lines above and below, the key ones there. The next thing being that I want you to understand here is that the way that price operates, so forget about the news and the media and all that junk, which is just a waste of time. The way that price operates is that these price levels are significant for multiple reasons. The first thing is that a lot of the underlying mechanics of any particular market, we forget about this. We think, oh, it's traders and the news that's moving the markets, but there's an actual underlying market. So for example, Apple sells products. It's not just Apple stock, it's Apple products. And so we forget, even currency markets, euro, dollar, there's an actual underlying market. Insurance companies, hedge funds, banks, tourists, people buying stuff online. There's so much that actually makes up that market. We forget those are a lot of the mechanics that impact the market, which is why there is this ebb and flow, because there's constantly people buying and selling to get in and out of the market for various reasons. We often forget that, and we think it's just traders. Like, this is just traders moving the market. It's crap. That's ridiculous. Yes, big decisions and executions are done by computer. So if you're wondering where the noise comes from, that's just people just buying and selling when you do an exchange with xe.com or you buy stuff on Amazon, sure. And then, of course, what also happens in reality is a lot of the bigger companies will then pile all those orders together and then execute them together to kind of try and find the right time, so that companies that are also executing on your behalf will also try to piggyback, which is a kind of a normal business strategy. They'll try to gain an edge. So they'll try to, instead of just charging you a fee for the transaction, they will kitty everyone's money together and then look to execute at an optimal time in the market during that day, for example, to do the actual transaction so that they can benefit from the move in the market. So what that means is, if the market is, if I've been instructed by a whole lot of clients to buy in this market, but it's going down, it would be better for me at some point to potentially buy when it's really overextended, and then kind of, you know, my fees or my profits on that move might be bigger. So just understand that effectively banks will also try to execute certain things at certain times, so that they can piggyback on the move themselves. It's common sense in a way. What they want to do, it's like buying in bulk. If you're going to buy something that you could buy in bulk, you get a bigger discount. So it's a business strategy. It's the same thing effectively in trying to do it here. So the kind of the next part that I want you to remember here. So these are the key levels. So price will effectively go from one key level to another. That's what it does. When it gets to that key level, it will then decide, do I turn around and go back to this level, or do I break through the level and go up to the next level? And this is amazing because what it does is I need to draw this on. So I'm just going to quickly grab the drawing tools, which I need to do, which I don't know if I actually can. Okay, they're not in place. Sorry, so I'm not going to be able to do that. What have I got? What's my recording toolbars? I wanted to draw on it, and I forgot to set up that tool. Okay, that's frustrating because I wanted to basically highlight that price will move from one level to another, then it'll decide what it wants to do, and that's what we do. So as traders, we operate within the area between the key levels. That's what we do. We capture. That's where the move is. So the market is pretty much decided where it's going to go, and we decide we're going to capture on that. We don't really trade on top of these areas. We will either look to get out just before the areas or look to get in just after the areas, outside of these areas. And so when price approaches those levels, like it does here, we start to monitor it for potential, for potential clues. In this case, this behavior here is very bullish. This implied the market was going to break out through that level. So this is something you will pick up over time, but it isn't always the case. Okay, in this case, it's also implying through the lower highs and the testing the level was going to break down, but there's no clues here. There's no clues here. I mean, that just had a strong reaction, but you couldn't have sort of necessarily benefited from trading that per se. And here there were no clues. There's no clues. So sometimes it will give us clues and sometimes it won't. But we operate within these levels. And the best ones are when there's a nice long run to the next significant level. The annoying ones are when there's a small level that's close by because there's not much room for us to trade. And sometimes what we'll do in those cases is go down to the lower time frames so that we have more room to operate. But otherwise, that's the key point. So this is something I want you to take note of. If you as a beginner trader can identify these key levels and understand that that's how the market works, you should start to see an improvement because you now understand if the market breaks through here, where it's probably going to go next. And that now gives you a space where you now understand pretty much what the market wants to do, whether it's going to go up in a straight line like this or whether it's going to bob around kind of like that can happen. But at least you now have a top and a bottom and you are able to organize the information in a better way. So this video is really about focusing on this as the foundation. If you do not master this part, this component, this idea for technical analysis, you cannot become a profitable trader. It's impossible. For discretionary trading and technical analysis, you can't do that. Because this is how the market actually operates. And if we don't piggyback and understand that, then you won't understand. So the most important key things that you have to master from this video that I've covered is first of all understanding how price behaves and how we identify those key levels. And then between those levels, how it behaves as it moves from one level to the next can vary, but at least we have an idea of roughly where it's going. And that's it. And so I think I'm going to leave that here, but that's what I want you to take away from this is look at price. Now, what is the trend here? It is uptrending. Is it overextended? Yes, it is, because I can visually see that price should probably be operating along here somewhere. So it's overextended, a bit of a rejection candle. So it's potentially going to pull back a bit and then take another run up at that level. All right, it hasn't touched that level yet, so I think there is still a chance that it will take another run at that level. It might come all the way back down and do it, but it's weird that it would just decide to turn here. Okay, if I'm not sure that, I can go back, but then I better find some really good evidence that that's an important level, and it isn't, because we didn't find it on a higher time frame. So this isn't really a key level as such. Doesn't mean it won't go all the way back down here, but that's weird. That's unusual. So I'm going to wrap up here, and give me some feedback on this, by the way, but this is huge, because what we do then is we add stuff on top of that. All right, so then we add moving averages, we add pivot levels, we add Fibonacci levels, and I'm going to start producing more and more content around those. But this video that I'm showing you now is the most important, and although it seems very simple, you'd be amazed at the number of traders who bypass this whole step and then can't understand why they're not achieving consistency, because they haven't understood this and they're not applying it. And so it's bringing people back to the basics to make sure that they've mastered it. And then you can, it's like mathematics. If you don't understand how to add numbers, you're not going to be able to understand more complex mathematics. But that's it. In essence, you can trade successfully just by identifying entries above and below these levels and price action patterns. You can do it all here. This is how we can do it. So, yeah, that's it. I'll leave you with this. Thanks very much.